Look at the bottom of many traders' charts, and you will see a second little window sitting underneath the price with a wiggly line bouncing up and down through a middle zero line. That is an oscillator, and today we meet one with a slightly mysterious name, the CCI. By the end, you will know exactly what it measures, what its signals mean, and the one clever trick that makes it genuinely useful. First, what is an oscillator at all? It is an indicator that does not sit on top of the price like a moving average does. Instead, it lives in its own panel below the chart, and it swings back and forth between extremes around a central line. Its job is not to show you the price, but to measure the momentum and the mood underneath the price. Think of it as a speedometer for the stock, separate from the map. Now the name. CCI stands for Commodity Channel Index. It was invented back in 1980 by a man named Donald Lambert, and originally designed for commodities, which is where the name comes from. But do not let that fool you. Traders quickly found it works perfectly well on stocks, indexes, and crypto too. The name is just a historical accident. So what does the CCI actually measure? In plain English, it measures how far the current price has stretched away from its own recent average. When a stock is trading right around its normal average, the CCI sits near zero. When the price sprints far above its average, the CCI shoots up high. When the price plunges far below its average, the CCI drops down low. It is a measure of how stretched, how extended the price has become. That gives us the central idea, the zero line. The CCI oscillates around zero. Above zero, the price is generally above its recent average, leaning bullish. Below zero, it is below its average, leaning bearish. And the moment the line crosses through zero, from below to above or above to below, that marks a shift in the short-term momentum, a change in the mood of the stock. But the real action is at the two key levels, plus 100 minus 100. When the CCI pushes above plus 100, the price is stretched unusually far above its average. The stock is running hot, what people call overbought. And when the CCI drops below minus 100, the price has fallen unusually far below its average. The stock is unusually cold, what people call oversold. These extreme zones are where traders start paying close attention. Now here is the trap, the same one that catches people with every overbought signal. Overbought does not automatically mean sell, and oversold does not automatically mean buy. In a powerfully trending stock, the CCI can pin itself above plus 100 and stay there for weeks, while the stock keeps climbing happily. Selling just because it looks overbought in a strong uptrend is a classic way to get left behind. The extremes are a warning to watch, not an automatic command to act. So what is the genuinely clever trick? It is called divergence, and it is the most respected signal the CCI gives. Picture this. The stock price climbs to a brand new high. But over on the CCI, the indicator makes a lower high than it did on the previous peak. The price is going up, but the momentum underneath is quietly fading. That hidden disagreement, price rising while the oscillator weakens, is divergence, and it often warns of a reversal before the price itself shows any crack. The same works in reverse at a bottom. If the price drops to a new low, but the CCI makes a higher low, the selling is losing steam even as the price falls, hinting that a bounce may be near. Divergence is the CCI whispering that the visible trend and the hidden momentum no longer agree. That is its real superpower. But, as always, we keep our honesty. The CCI is not a magic oracle. In a flat, choppy market, it will fire off constant false signals, whipping above and below its lines with no follow-through. And in a strong trend, it stays pinned at an extreme, looking wrong for a long time. This is exactly why no professional trades a single indicator alone. The CCI is one piece of evidence, best confirmed by the trend and by price itself, never a standalone buy or sell button. And the final note you can predict by now. None of this is required for the long-term investor. If you're buying a broad index fund every month and holding for decades, you never need to glance at a CCI or any oscillator because you're not timing momentum at all. This is a tool for the active trader reading a single stock, not a requirement for building patient wealth. So look again at that little wiggly window beneath the price. You now know it is the CCI, a speedometer measuring how stretched the price is from its average. Around 0 is normal, above plus 100 is hot, below minus 100 is cold, and a 0 cross marks a momentum shift. But its true gift is divergence, the early warning when price and momentum stop agreeing. Use it as a clue, never as a command. I'll see you in the next one, where we meet the VWAP. Until then, keep it simple and read the speedometer, not just the map.